Alright, let's get right to it. It happened fast. 1 minute we were cruising. Mortgage rates dipped below 6%, a sweet spot we had not seen in years. Buyers felt that spark of hope. The market was buzzing. Then, bam, the rug was pulled out from under us. In a few weeks, those 5% rates vanished. They were replaced by much higher numbers. Mid-sixes, folks. Not a slow crawl. A rocket launched the wrong way. What just happened? Let's break down the numbers. Weeks ago, Freddie Mac had the 30-year fixed at 5.98%. Fast forward to early April 2026, different picture. Freddie Mac on April 7, 6.46%. Almost a half-point jump in weeks. In home loans, that is massive. It changes your monthly payment, it changes your buying power, it changes the whole game. Confusion followed. It feels like whiplash. First things first, the real boss of mortgage rates. It is not who you think, it is the 10-year Treasury yield. Think of it as the barometer for long-term borrowing. When that yield goes up, mortgage rates almost always follow. Lately, it has been pointing up. The market got spooked. Before tensions, the yield sat below 4%. Then it surged toward 4.36%, 4.5%. Lenders had to keep pace. Mortgages become MBS. Investors compare them to treasuries. MBS must yield more than treasuries, so rates rise with the 10-year. Key lesson, watch the 10-year. Next, inflation, the silent thief. Higher inflation shrinks real bond returns, so yields move up. Enter oil, the accelerant. Conflict and shipping threats lifted energy prices. Crude pushed toward $108 a barrel. Energy costs ripple through transport, manufacturing, and utilities. Fears of hotter inflation. Investors sell bonds. 10-year up, mortgages up. A domino effect to your wallet. Let's tackle the most misunderstood player, the Fed. For months, many bet on quick cuts and falling mortgage rates. Now, fewer or slower cuts are expected. Important, the Fed sets an overnight bank rate. Mortgage rates are long-term and market-driven. With oil up and inflation risks back, the calculus changed. Markets priced out cuts, keeping the 10-year elevated. Another force, wider spreads between MBS and treasuries. Volatility and uncertainty push investors to demand a bigger premium. The Fed is letting MBS roll off, reducing a major buyer. If rates fall, refinances surge. If rates stay high, they stall. Cash flows get unpredictable. Result, even with a steady 10-year, mortgage rates sit higher. Think of multiple judges. Bond market, global politics, investors. Their votes pushed rates up. Know the judges, build a strategy, and you can still win. So, rates are up. The market is volatile. Stop trying to time the market. It is a fool's game. Catching the perfect low is like catching lightning in a bottle. Daily numbers swing. Do not let noise paralyze you. Your goal, be a strategist. Improve your credit score. Build your down payment. Compare 30-year, 15-year, and ARMs. Ask about points to buy down your rate. Shop multiple lenders and compare fees. Remember, you marry the house, you only date the rate. Refinance later if it makes sense. Mortgage rates jumped because of rising treasury yields, fresh inflation fears in oil, fewer expected Fed cuts, and wider MBS spreads.